Okay, guys, why don't we get started at 6 o'clock? And as we know, partnership tax always has a lot, right? So never disappointed with the amount of material. So let's just quickly review what we've covered to date and where we're going. Chapter 1 is an overview of subchapter K and how it differentiates between C corporations and S corporations. That's the two primary challenges or other business forms to do business. And as you know, at least you've heard me say it, I would say for most of our clients who are not the IBMs or the Googles of the world, LLC is probably the right way to start for your client, okay? So, and who knows where this is going? If and when there's tax reform and pass-through entities get a special 25% rate, brace yourself. We're about to be very busy practitioners, okay? For good and bad reasons, all right? Formation issues, 721. Everyone can handle this. Generally tax-free, right? Generally tax-free, with a caveat that when there are two different caveats, I should point out. One which will become clearer today. Caveat 1, if you contribute property subject to a liability, then you may, emphasis on the word may, have to recognize gain if you're shedding a lot of that liability, right? Consider it as a distribution. And secondly, this is not going to come as a surprise to most people who've had corporate tax, if you contribute services, right? And you get back a partnership interest in return for services, that too is going to be taxable. This is very similar in the corporate tax area. This is Code Section 351. Generally not taxable if you form a corporation, but if you contribute services, Section 351D specifically says the receipt of a corporate interest in return for services is taxable. So do bear in mind, formations generally tax-free with those two caveats, all right? So and again, the authors bring up liabilities early on, Code Section 752. Why? Not just to play with you, but the fact is many formations engender property subject to a liability. Towards the end of the chapter, we talked about organizational expenses, which are that's under 709, very similar to startup expenses under 195, or in the corporate realm, Code Section 248. We talked in general about partnership operations. Okay, those are detailed in the next chapter. Just very generally, if the partnership makes money, you get taxed. If the partnership, even if there's no distributions, right? That's not the benchmark for taxability distributions, which we'll cover in another 2 weeks or so. 2-3 weeks, we will cover distributions. Generally, are tax-free, right? Distributions are generally tax-free. Check out Code Section 731 with the caveat, what do you need so that distributions are tax-free? Basis, right? Everyone agree? Basis is generally good, right? So you need basis. Why do you need basis? Again, protects you from taxability, okay? We're going to see that's not always the case. There's Code Section that will haunt some of you. Code Section 751, just a little forewarning. Code Section 751 is one of those dangerous code sections. You may recall, I'll remind you, you know how sometimes Code Section 1245 can come to haunt you, right? You think Code Section 1231, and I've known many people, practitioners, lawyers, accountants, and others, they think to themselves, gee, I have a 1231 asset, and I'm going to have capital gain treatment, right? And they forget 1245, and what else do they forget? They forget possibly 1231C, right? The recapture rule, where you got to look back 5 years. Well, similarly, we're going to see, I don't know if it's subconscious or not, practitioners, some, not you guys, forget code section 751. And if you forget it, it's to your detriment, okay? 751, be forewarned. It's a code section that comes to haunt practitioners, okay? So make a mental note. It comes to haunt practitioners, and believe it or not, I know this will come as a surprise, some students, even on exams, forget code section 51, 751. That's not you, I'm sure. You guys will be the exception. Not a single person here tonight will forget it. But just again, it's important to remember code section 751. Okay. I was going to say something, but then smart enough to stop myself sometimes from saying things. Okay, not always though, often not the case. All right, so we talked about the fact that if you make money, what happens? You get taxed on it, but your outside basis increases. Partnership losses, basis goes down, right? But with losses, we recall there's several different code sections that may suspend those losses. 704D, 465 at-risk rules, and 469 the passive activity rules. Okay, so that's how we ended chapter 3. We talked again. We said that the piece de resistance was chapter 4 about partnership allocations and the flexibility, right? Partnership allocations have compared and contrast. S corporations, right, can only have one class of stock, right? It can be voting or non-voting, but it's not very flexible, right? You can't have special allocations to S corporation shareholders, right? And then C corporations can have multiple classes of stock, but comes at a steep price, right? Double taxation. In contrast, as long as we have what? Substantial economic effect, right? You can have special allocations, all right? And that means that you got to maintain your capital accounts to ensure that there is economic effect, and then go for it, right? And the only thing we said towards the end of the chapter, if I recall correctly, that when it comes to non-recourse deductions, there can't be substantial economic effect because there's no liability associated with them. But if there's a minimum gain chargeback where the amount of the liability decreases or there's a subsequent gain and the person who got that allocation is charged back with it, that's perfectly permissible, all right? We moved on from there, and we talked about some, let me just see if I can keep flipping pages. Okay, get to the next chapter. Partnership allocations, income shifting safeguards, and these deal, if you recall, primarily with contributed property, right? That you don't have as much flexibility with contributed property, and Congress does not want people to assign either income or losses away from the contributing party. And there's 3 different methodologies, if you recall. The traditional method with remedial allocations, and then just plain vanilla remedial with curative allocations. And the third, just the remedial method. We went through different examples of what would happen if contributed property is sold, and also with respect to depreciation deductions. We talked about partnerships in the family context. Once again, Congress is nervous that taxpayers might play games. There's a dedicated code section 704E. 704E that says that partners are not at liberty when it comes to family members play games. Chapter 6 deals with partnership liabilities. I tried at the beginning of last class to go through and say, hey, we're all familiar with the Crane and Tufts decisions, right? And how the code and the Supreme Court cases permit taxpayer basis, right, with respect to liabilities. If you acquire a building using debt, that you nevertheless get a cost basis equal to the fair market value of the property. And that Code Section 752 in the partnership tax context tries to replicate that. I did point out, if you recall, that this chapter looks at two different kinds of debt. And for exam purposes, it's critical that you identify what kind of debt it is. Again, it doesn't hurt for exam purposes to bring that special red pen, right? That will help you delineate, is it recourse or is it non-recourse, right? Because there's very different tax effects depending on which one is at play. Regulation 752-2 applies to recourse debts. Regulation 752-3 deals with non-recourse debts, right? And I advise you that just like the authors of our textbook, professors can't veer from the examples in those regulations, okay? So do take a look, if you haven't already, at those examples, keeping in mind when it comes to recourse liabilities, what's paramount? You go through what? Constructive liquidation, right? What happens if everything becomes worthless? Who is left holding the bag? And to whomever the burden falls, if there is complete debacle where all the assets become worthless, whoever's left holding the bag, that's to whom the liability is supposed to be allocated to. In contrast, with respect to non-recourse, there's a three-tiered methodology. And the first tier looks at whether or not contributed property, and if I say this correctly, if the amount of the liability exceeds the book value of the property. Let me repeat that. If the amount of the liability exceeds the book value, there is a 704C tier. It's not going to happen too often, where the amount of the liability exceeds the book value, because most taxpayers would walk away from that property because the liability is in excess. It's non-recourse. They're not going to hold on to that property. The second tier is the more traditional tier that we've often seen, where the amount of the liability exceeds adjusted basis, right? The liability exceeds the adjusted basis. And we have a name for that, right? And it's called minimum gain. Everyone agree? That's the minimum gain. And if you want to put another name to it, lots of names in tax, right? Tufts, right? The Tufts case. And then the third tier, whatever is the excess, is divvied up in accordance with partnership profits, right? Partnership profits. So those are the three tiers. For exam purposes, I try to keep it straightforward. We didn't quite finish last class, and I know if I spend 15, 20 minutes or a half an hour going through it, I'm not going to ask something that challenging. So I think our time is better spent moving on to the next chapter. Let me just tell you what our objective is today, guys. We should, things fall into place, finish chapter 7 tonight, okay? And I actually want to begin chapter 8. The first problem there is just a summary of chapter 7 of sorts. And assuming we achieve our objective, then just for those who wish, the next chapter is relatively short. Okay, so chapter 8 is relatively short, and if things fall into place, just mentally, if I forget to make this announcement, I hope to get to page 302 next class, okay? So that gives you a little idea of what we're going to try to achieve, okay? Questions? Okay, question, Amir.
What's the final?
The final, I believe, is December 8th or so? 6th, December 6th. Okay, that should be our 14th class.
It is.
It is.
Andrew?
We talk about recourse and non-recourse loans. I'm just curious, in practice, how often are non-recourse loans given out by banks and stuff? I don't see why.
Ask Donald Trump. I mean, again, if you're big enough, if the bank is hungry enough, they'll do it. I'll take myself, I won't put yourself in this league, Andrew. No bank is going to lend Solid money on a non-recourse basis.
Yeah.
They're going to want my firstborn. All right? But again, if you're big enough and they think they can get enough, again, if they think you're well collateralized, they may give you a non-recourse loan. Everything's good until it isn't, kind of thing. Other questions?
I was trying to go to the example. In example 1 of 752-3, I wasn't sure.
Example 1 where?
Of 1.752-3 in our regulations.
You know what? Send me an email where you think you're going off, and then I'll be happy to see, where you might, to the extent I can help. All right, because I know if I start getting into that, we're never going to get done with what we need to. Other questions, general? On my Monday night class, I asked if anyone did anything interesting this weekend, and over that weekend in that class, someone proposed, so we got to hear about the proposal in an apple orchard. Anyone can top that? Anyone do anything this weekend that rivaled getting proposed to, or nothing? You washed your car?
That's all I have.
I did see, I told my Monday night class, I did see this exhibit in the New York Botanical Garden, Chihuly, did I say that right? Chihuly, thank you, it was phenomenal. If anyone has been to the Bellagio Hotel in Las Vegas, all the glass work this guy's done, at the New York Botanical Garden, it's there until Saturday, and it's been there for several months. But this Friday, if you're not doing anything, guys, I'm telling you, it is an art exhibit the likes of which I've seen a fair amount. This was pretty incredible. So I did see, that was what you should see, and then I also told my class what you shouldn't see. I saw the movie. I was held hostage by my wife and daughter, elder daughter. What is it called, Girl Trip? I did not think it was that funny. Anyway, that was it. Were you going to say something?
I went to the Pentagon.
You went to the Pentagon? And do they have tours, or you?
Oh, my cousin got promoted to the rank of colonel.
Okay, congratulations. Was it interesting? Was it?
It's like a mini city. It's really cool.
Okay.
So they have everything in there, literally.
They have what?
They have everything in the Pentagon. It's incredible. They have a dentist, they have a DMV, they have Popeye's chicken. Yeah.
Wow.
I'm assuming they had some very special security clearance to get in?
It's as bad as the airport.
Or as good as the airport?
Oh,
Yeah. So you felt safe inside, right?
Absolutely.
All right, good. All right. Anything else? No one else went to the White House or anywhere else? All right. You guys ready? Let's talk chapter 7 again. Over the next few weeks, guys, before we blink, next week starts November, right? Believe it or not. We blink again, it's Thanksgiving, we blink again. Here we're going to be here for exam. So keep up partnership tax. You guys are making a lot of headway. We're not going to exactly finish the textbook, but we're going to try to come pretty close, okay? So, let's talk about compensating the service partner, okay? And good news, compared to capital accounts and some of the other things we've looked at, guys, this should be pretty straightforward and somewhat addressing tax fundamentals. All right? Famous last words, right? So, if you could, open up code section 707, not a bad place to open up. So one other thing, if you could, I'd be derelict in my duties, you only have to hear me say this one more time, probably next week. Again, Sunday, November 5th, if I get my dates right. Anyone who hasn't, consider joining us for brunch. I hope it will be entertaining in many, many different levels, okay? So if you're not doing anything, you can join us. That'd be terrific. And if you have any questions regarding that, let me know as well. All right, so code section 707, we have, look, the authors make clear, for exam purposes, you should know that payments to a partner can come in multiple flavors, but the three most important are payments made to or equivalent to a non-partner, right? 707A1, okay? So the person is not acting in their capacity as a partner. This is 707A1 payment. By way of contrast, if someone is acting in their partner capacity, they're acting in their partner capacity, they get a distributive share, right? They get a normal distributive share. And when I say distributive share, they may make money, they may lose money, right? That's the nature of distributive share. They may make a lot of money, they may lose a lot of money, or somewhere in between. And right in between those two, so we have a non-partner on one side, you have someone who's acting as a partner on the other end of the continuum. We have something called guaranteed payments right in the middle. These are 707C payments, code section 707C payments. And here, the payments made to a partner is partner capacity. So it's being made to a partner in their capacity as a partner. But in contrast to a distributive share, the amount is guaranteed. They have to be paid this amount. For timing purposes, the guaranteed payment is treated as a distributive share. For timing purposes, guaranteed payment is treated as a distributive share.
What does it mean for timing?
It means, for timing purposes, when the partnership year closes, dictates when they must take it into income. Even if they don't receive it. Okay, so the authors are going to elaborate, right, on all three statuses. And needless to say, for exam purposes, no, I'm exaggerating a bit, but 9/10 of tax is making proper identifications, right? What's the issue at stake, or what's the transaction at stake? You know, is it part sale, part gift? Something that you can identify, and if you properly identify it, guess what? You can find the right code section. You find the right code section, you'll find the right regulation, right? Or you'll find the right other administrative authority. Failure to properly identify, not good, right? Chances are you will not succeed. All right, so the authors are going to elaborate here about each one of these capacities. And we first have partner acting in a non-partner capacity. And we have Pratt v. Commissioner, 1975 case. And There's a game that taxpayers like to play that used to be available. What was the game that taxpayers like to play? Defer income, right? Defer income. And how was this game played? Well, the partnership typically was an accrual method taxpayer. It would accrue a deduction. There's a code section 461 that allows you to take deductions. And you could accrue it, right? Accrue your deduction. But you had a cash method taxpayer. So the taxpayer didn't have to take it into income until they received the cash. Taxpayers love playing that game, right? One taxpayer gets a deduction, the other doesn't have income, or at least can put off the income. Having said that, subsequently, before the Pratt case, Congress, when I say before, excuse me, Pratt was decided before this came into being, Congress enacted Code Section 267A2 and 267E1. The game was put to an end. Essentially, related taxpayers, in this case the partnership and the partner would be deemed related parties, are prohibited. The partnership is prohibited from accruing a deduction until the partner takes it into income. Okay, I'll repeat. And for those who've had the income tax course, this comes at the very end of the course. These code sections, 267A2 and 267E1 and 2, for the proposition that you can't accrue a deduction until someone else takes the money into income. So that game was put to an end, but that's just a little background because in Pratt, that's what the taxpayer was trying to do. And the taxpayer was saying that the management fees they received were not in their capacity as a partner. So here, the taxpayer argued code sections, tried to argue code section 707A1 was at play. Was the taxpayer successful? Taxpayer is not successful. Court says, look, these management fees were in the normal scope of the duties of a partner, and since they were in the normal scope, this was merely a distributive share. Okay. So this did not constitute a 707A1 payment. This constituted a normal distributive share. Maybe a special allocation, but nothing more, nothing less, because they were acting in their capacity and performing their services as partners would, similarly situated. Armstrong v. Finney, if I pronounced that correctly. This is a little bit unusual. Some of you in this room, I know, practice partnership tax or complete Form 1065s. Have you ever seen instances where partners can play the role of an employee? Anyone? Anyone? Not really, right, Dale? How do you treat partners generally for tax purposes? Treat them as employees, or what do you treat them as?
That's a question with a very specific answer. That's a very vague question. You need to leave me a little bit more.
Well, generally, anyone else venture an answer? Lisa, don't you do returns?
Not partnerships.
What do you do, Lisa?
Corporate tax.
Corporate tax, okay.
So,
You get it passed. Often self-employed, right?
Oh, okay. Like I
Okay.
said, very specific answer, very broad question.
All right.
A little bit more.
this is one of the few cases, and I'll venture to say the only case, and the court doesn't even decide it, it remands it back down to the lower court. It opens up the possibility that a partner could be an employee of a partnership. And the IRS has taken real issue with this case. And to my knowledge, even though we're on the 10th edition, guys, and this is a case from scary 50 years ago, it has not been revisited in a way. So this is an outlier, in my opinion. I think the authors bring it here just to say, interesting, but when you read the note that follows, 4 lines down, because the point of this case is if the taxpayer can be an employee of a partnership, you guys know that there's many code sections, right? Employees can avail themselves of, right? What code sections come to mind, guys? Well, we know 119, right? Anything else that's near and dear to your heart? Aaron? 132, right? Fringe benefits. Code section 105, 106, healthcare, right? Insurance. Right? Code section 79, group term insurance. There's just a slew of code sections that once you become an employee, right? There's just, it opens up the door to the application of many code sections, right? All right? To date, the IRS has not looked upon this case fondly. Again, it was reversed and remanded. We don't know what it was probably settled, okay? Because there's no subsequent history to this case. But if you look at the 4th line down, 3rd line down, under the note it says, in response to the Armstrong decision, the IRS has taken a hard line opposing this prospect of an individual's dual status as a partner and employee. Okay? So they've essentially said non-starter for its purposes. Okay, so this is not your go-to case to cite to or start telling your clients, hey, you can also function as an employee. Very, very risky position. The authors do a nice job on page 214. Look at the difference between the application when someone is operating. The first paragraph on page 214 goes through an example. That first paragraph, it says, gee, sometimes when someone is functioning as a non-partner, it produces certain tax effects. And it would be the same tax effects as that person had a distributive share. Okay, so that sometimes the outcomes can be the same, but in the next paragraph, the second full paragraph on page 214, they go through and point out that whether or not it's going to be a 707A1 payment or a distributive share can produce very, very different outcomes. So just be aware that there are differences that can come about depending on the status. At the very end on page 215, the last full paragraph before the problems, the authors describe about how code section 267A2 and 267E function. And if you look at the last sentence, right before the problem on page 215, what I have highlighted in red, it says thus, an accrual method partnership may not deduct an item owed to a cash method taxpayer prior to the year in which the item is paid and properly included in the payee's income. So let's look at the problems. These are not designed or meant to be complicated. On page 215, Armstrong v. Feeney holds that a partner who is compensated for services under 707A1 can achieve employee status outside of subchapter K. What types of services are within Code Section 707A1? Are they normally the types of services rendered by employees? And when you think of 707A1, guys, what kind of, anyone want to give an example of what that might be? What comes to mind is some good examples when partners act outside their capacity as partners. Alicia, you're going to say?
I remember reading something for the real estate partnership.
All right, so Alicia and I form a partnership. Got the visual? Lafayette will include you in the mix too. All right? And the three of us form this real estate partnership. And if you don't mind, I think I'm the only lawyer among the three of us. And I decide that I'm going to charge the partnership $1,000 at closing, right, to acquire real estate. But these guys, I mean, I consider myself theoretically, hypothetically, a real estate expert. They do too. They could hire a third-party attorney to do the closing, but they hire me, and they pay me $1,000 at closing. Well, that $1,000, right? I'm not acting as in my capacity as a partner. I'm doing it more or less as an independent contractor, right? And we can think of various examples where people form partnerships and then they retain the services of that partner to do something outside the normal scope of what that partnership does. Because that person brings a unique talent, right, to the table. Often that person will want a fixed fee, right? Because you would otherwise have to hire someone for a fixed fee, right? To do the closing on the real estate. Am I the traditional employee? What distinguishes employees from independent contractors, guys?
Payroll taxes.
That's a conclusory. I mean, what factually distinguishes employees from independent contractors? I hear it, but I'm sorry? Well, I know W-2s and 1099s, but my point is, an employee, right, you get to dictate how the work is done, right? You get with a traditional employee, wherever you guys work, you are given your computer, you're told what to do and how to do it, right? Independent contractor, you tell if you hire a painter, you tell how the painter is supposed to paint your house? Or do you say, I'll pay you X dollars, do a good job? And you don't supply the paintbrushes and the tools, right? That's the traditional indicia, right? That distinguishes independent contractors from employees. And when Lafayette and Alicia hire me, they don't tell me how to, the legal aspects, right? How to close on the property. And that's what you see traditionally with a 707 payment, right? It's really not done, this notion of being an employee. So again, that's an outlier, the Finney case. So in response to question 1, what types of services are within? Traditionally, they are the types of independent contractors. And then we talked about question 1B, what code sections come into play, right? Spoke about all the code sections apropos to employees 132, 119, 79, 105, 106. There's a whole host of code sections that when you're an employee that might come into play favorably. Come into play. Question 2. The AB partnership is a real estate development business. The partnership recently was involved in a lawsuit concerning legal title to a parcel of land it acquired. The partnership paid B, who is a lawyer, a $5,000 fee to represent it in the legal proceedings. How should the partnership and B treat the payments for tax purposes? So again, Lafayette, Alicia, and myself, they're going to hire me. Nice, I make $5,000. How should that be handled for tax purposes? Chad, were you going to say something? Feel free though. Have any thoughts here? How would you treat that, Chad? I'm sorry? So how does the partnership treat it? Remember, we got to look at how the partnership should treat it, how the individual should treat it. So how about the individual, meaning me? I'm the lawyer getting the $5,000. How would I treat it? I'm sorry? Let's skip the word personal. Let's just call it by the traditional income, right? What code section? 61, right? Everyone agree? Code section 61. Someone gets $5,000. Thank you, Lafayette. Thank you, Alicia. Check made payable from the partnership to me. I have to include it in income, right? In this case, David, how would you treat it for the partnership purposes? I'm sorry? Okay. Larry, would you agree?
Only when the partner gets the income.
I got the income, so you would allow a deduction?
Yes.
But what Lisa, do you always have to worry about? Something? Right. Because we all practice and we always have to be nervous, right? Come here.
It's 2% if it's just on the deductions.
Well, what do we have to worry with respect to deductions? Capitalized, right? Code section what? What code section? 263. Tamara, right on point, right? 263, right? And in this case, if you look at the regs under 263, this would be the traditional expense that you would anticipate capitalizing, right? A payment made to protect title is usually something that should be capitalized. So, notice the asymmetry, right? I have immediate income, partnership has to capitalize the deduction. All good? Now it could be, David, it could have been a deductible fee if it was something that, lended itself to Code Section 162. But the authors purposely, I think, did this to just make sure you recognize or be careful with respect to, or point out the asymmetrical possible outcomes. Disguised payments. Look at Code Section 707A2A. If these three conditions are met, a partner performs services for a partnership or transfers property to a partnership. There's a related direct or indirect allocation and distribution to such partner, and the performance of such services or such transfer, and the allocation and distribution when viewed together are properly characterized as a transaction occurring between a partnership and a partner acting other than his capacity as a member of the partnership. Such allocation and distribution shall be treated as a transaction described in paragraph 1. So, sometimes partnerships and partners look to play games, and there's code sections, right? When we know that taxpayers have a proclivity to play games, for example, husband and wife, right? We have code section 1041. Everyone agree? And that's to limit the ability for a husband and wife to get gains and losses because that would be just way too convenient. Agreed? Similarly, partners, presumably Lafayette, Alicia, and myself, we have as, we're not married, the three of us. And nevertheless, we have a close bond, right? And we certainly have a common economic interest. Congress recognizes that and says that we might decide to put things together in a way that it looks like a distributive share to me, let's just say, to me, when in fact it's really a payment, okay, that belongs under 707A1. Okay, so let's pause for a moment. Partnerships may disguise distributive shares, which truly are not distributive shares, and they should be, instead of treated as distributive shares, they should be treated as if it were a payment to a non-partner under Code Section 707A1. What the authors do is on page 216, and we're going to see our own example of the problems, but on page 216, they give the first full paragraph, the example of proper treatment, and the second full paragraph on page 216, they show how taxpayers might try to manipulate the outcome and produce better tax outcomes. And once they give us this illustration, the authors will walk us through some legislative history. And why do they walk us through the legislative history? Is to point out, and that's the indented language beginning on page 217. They want to walk through and point out the factors that Congress says that practitioners and taxpayers should consider. These are factors to consider in deciding whether or not Code Section 707A2A applies. What are the factors? They begin on page 218. First factor to consider is that of risk. If the payment to a partner, in my example with the three of us, if the payment to me engenders risk, it has an aroma of being a distributive share. Because when the three of us, Lafayette, Alicia, and I, function as partners, there's risk, business risk, right? But if there's very little risk for me to get paid, that has a much stronger aroma of being a 707A payment, right? Everyone agree? If there's risk, it's likely to be a distributive share. If there is little risk that I will get paid, or a smaller amount of risk, then it's more apt to be a 707A1 payment. If my role in the partnership, second factor, is transitory, I ain't going to be a partner for long. Okay? I'm in and out. That suggests that maybe, heck, I'm not a partner after all. With Halloween coming up, maybe that was my costume. I was just going to play the role of a partner. And it was transitory. It was just one night. Or maybe it was just a week or a month, but it was just transitory. guess what? It's less, if it's truly transitory, then it's more apt to be a 707A payment, right? A1 payment. Transitoriness.
So essentially, you can't just be a partner during the time that you're providing those services, right?
Right. If my role, I'm just, during the time I'm giving or supplying the services, I'm the partner, and then I disappear into the sunset, suggests that I am probably not truly a partner. Proximity in time. If I render certain services, and if there's a special allocation to me, well, that's suggestive, not definitive, but suggestive that maybe I'm being paid in my non-partner capacity. And the final factor is if my interest in the continuing interest in the partnership is relatively small. That too suggests that I am not truly a partner. My continuing interest in the partnership is relatively small. It suggests that I am not truly a partner. So guys, this is not one of those black and white tests, but it's designed to have a chilling effect, right? Congress put this in because taxpayers otherwise could come up with these devices and feel, gee, Congress didn't know, the time of day. And now you as a practitioner can at least go back and warn the client that, boy, if you undertake this transaction, there's a code section directly on point. It may not work, and not only may it not work, you may have to pay a substantial understatement penalty, or it may be considered negligent under code section 6662 is the big penalty section. And the material that follows on page 220, and then at the end of the chapter, there's a fairly lengthy discussion of what's called the 2 and 20. Okay? Are you most of you familiar with so-called carried interest in the 2 and 20 that maybe you've heard Donald Trump talk about and Hillary Clinton and others? Bammer, have you heard that? No? Anyone hear about the 2 and 20? Go ahead. Jonathan, I forget. Yes, you've been immersed in that, right?
Yeah, so.
All right, good. You're a good person to hear. So, Jonathan, just tell for the class your background, your familiarity, and your thoughts on 2 and 20, how it works.
I work in financial services. I work with hedge funds frequently throughout the year administering clients.
All right, so Jonathan's background does a lot of hedge fund work, right? You do the returns for the hedge funds?
No, I'm more on the financial services side.
Okay, you're on the financial service side. So how do hedge funds make money, Jonathan?
We charge generally 2% management fee, and then they get to keep 20% of your returns.
All right, so everyone get the visual. You have a hedge fund, and people make investments, and the quid pro quo, if you're going to get with the right hedge fund, right, Jonathan? You should pay a 2% management fee, which the hedge fund takes as ordinary income, right? The partners who are involved in the partnership, the hedge fund, AKA hedge fund, get a 2% management fee, and the management fee, their job is to manage, right, the investments, and they're going to be paid 2% of, is it 2% of the return or 2% of the
2% of their assets under management.
That's what I thought. So if it's managing, just keep the numbers simple here, $100 million, it gets $2 million, no matter how the fund does, good or bad, okay? 2%, right? Now, in addition, it also gets what?
20% performance.
20% performance fee. Now, what does that mean for everyone?
If you had a $100 return on the year, the firm keeps $20.
So it's only on the profits.
And generally, it's
So
not
there's,
more.
I'm sorry?
And there's more to it. Generally, if you have to hit a certain target.
Right, you have to get a certain target, and then, I mean, there's all sorts of things, but keeping it real simple, if the hedge fund has 100 million under umbrella, and it gets, say, 10% return for 10 million. And assuming that reaches the threshold, it gets 20% of the 10 million, right? Or 2 million, okay? So everyone get the visual, it gets another 2 million, but what's the character of that income?
Carried interest.
Carried interest, which should be capital gain, right? Okay, so the first 2% is ordinary income. The 20%, okay, of profits, and timing is an issue here too, because typically it may be deferred, but they typically will recognize that in the form of capital gain. And guess what? That pisses off a lot of people, right? Because now, Jonathan, do you work for the hedge fund, or do you work doing advising?
It's a separate entity of the company, but we administer it. So it's a subsidiary, so I don't directly work for them.
Okay, I guess my question, are you a partner there, or?
No,
So you don't have a skin in the game?
no.
All right.
Go ahead.
All right. So the question, for a lot of taxpayers who aren't part of hedge funds, is this compensation arrangement fair or equitable in terms of how it should be taxed? Right? Alicia's shaking her head. Well, Jonathan, you're on the inside. Yeah, we are being taped, so you better be careful what you say.
Personally, I don't mind it.
I mean, it doesn't directly help you,
Right.
only indirectly.
Yeah.
But just, do you have any, what do you see as why this is the right way to tax?
I mean, technically there's a risk involved with it that makes it similar to investing in and of itself, but I understand the criticism of it, and I don't really adamantly oppose it. It's
I
just
mean,
a matter of,
I can't see much, I don't, hold on, let me rephrase that. In terms of Trump tax reform, I can't imagine how they would allow this to stay as is.
I don't see a compelling case to keep. And
Right. I see this, if there's any, because this is, whether it's right or wrong, the perception is, and it nerves, well, it does inure primarily to people who are very wealthy. And most people would argue that it should be, hey, it's really, they're doing their management, they're being paid compensation. It should not be taken in the form of capital gains. All right? So we can anticipate the 11th edition of our textbook. If tax reform does happen this year or next, I would imagine that the 2 and 20 may go by way of the dodo bird, but we'll see. All right. For exam purposes, you're not being tested on it. Okay, we're going to keep it really basic, but I'd be derelict to my duties not to point out this is a hot button issue. That the next several weeks, guys, you're going to see a lot of airtime, I suspect, on this. Okay, and the only disappointing part is even if this loophole, quote unquote, if that's your perception, is closed, it's not going to raise nearly the kind of revenue that Congress is looking for, insofar as trying to permit lower tax rates. So it sounds good on paper, but it's not going to be the grease that permits tax reform. Okay? You guys ready to look at the problem on page 221? A, cash method taxpayer is an equal partner in ABCD partnership. And keep in mind, not surprising, a partner is a cash method and the partnership's accrual method, okay? Everyone have the visual? Very common. Right, Jonathan? Your partnerships, that the hedge funds are all accrual, right? And we, individuals, right? 99.99% of the time, we are on the cash method. Has $10,000 outside basis, right? And you guys, by week 9, you know what outside basis is, right? If you don't, that's going to be scary. In her partnership interest. A provides regular ongoing services that are not related to the primary business activities of the partnership. I have the word not circled, okay? These are the kind of words, for exam purposes, it behooves you to circle, right? Like recourse or non-recourse, just to remind people. So A provides regular ongoing services that are not related primarily to the business activities of the partnership. Before any of the transactions described below, the partnership has $10,000 of net ordinary income from business operations each year. What results in the following alternatives? The partnership will pay A $2,000 per year for 3 years for his services. Right, so guys, we need to know the effect to the partnership, okay, and to the partner. Okay, everyone agree? We need to know the effect to the partnership and to the partner. So Doris, what's the effect to the partnership, and Angie, what's the effect to the partner? Josh, you can see if you agree. What's the effect to the partnership? Well, Angie, you're saying, you're raising the question, rightfully so. Is this 162 or 263, right? Expense, agreed? And we want to know, but assume it's deductible, Angie. Can the partnership take the deduction? I'm sorry? You're whispering.
No.
Why not? Doubt? Any reason? You think you could? Angie, I don't know why not. It's 162 expense, right? Doris, what's the effect to the partner? Now, look, the partnership can't deduct, right? Until the partner takes it into income, right? What's my authority? What's section 267A2? Agreed? So Angie, on that basis, the partnership can't deduct. But assuming it's a legitimate deduction, it could deduct. Doris, do you have income as the partner? You're whispering.
I said I would think so.
Yeah, code section 61, what kind of income? Ain't no hedge fund, right? 2,000 ordinary income. Amber, you were going to comment? Yeah, 2,000 ordinary. Yo?
Is there a ownership percentage rule to define related party here?
You mean for purposes of code section 267 and the limitation?
Yes, because A is at 25% owner in this case.
Yeah, if you look at code section 267, let me just see, E1, I believe it's any partner in partnership.
Okay, it might be.
Yeah, that's the case. So there's no threshold.
Okay.
It's not like code section 368C where you need 80% or some other threshold.
Okay.
You're deemed to be a related party if you own an interest in the partnership.
Okay.
Okay? All right, so for your notes, everyone has question A. Right? Partnership can deduct with the caveat of code section 267A2, and the partner has 2,000 of ordinary income. Question B. What results in A above if the compensation payments are made on January 31st of the following of the year following accrual? Amber, you were going to say?
It's the same.
No deduction until year 2.
Yeah.
Okay?
But for number one, it was 6,000, right? So it's after 3 years. So it's just
Well, we'll pay 2,000 per year.
so it's,
I'm assuming it's being paid contemporaneous, not after 3 years. Amber. Okay? Question C. How did your answer to A change if the partnership generated no income from business operations for the year, but instead generated $10,000 worth of long-term capital gains? Okay? So, what would happen here? What would happen with the partnership? Vera? Javier? What would happen? Don't overthink it. Dixie, were you going to say anything? Marcel?
Would the partnership still have a loss of 2,000? The partner would still take the 2,000 as ordinary income, and then the long-term capital gain is still treated separately?
Yeah, the partnership would have a $2,000 loss, right? Allocable $500 apiece, right? There's 4 partners. It would have $10,000 in capital gain, allocable $2,500 to each, right? And A would have $2,000 of ordinary income. I'll repeat your notes. The partnership would have $2,000 of ordinary loss and $10,000 in capital gain. Each partner would have to take into account their pro rata share of that, right? So that would be $500 loss per partner, ordinary loss, and $2,500 capital gain for each partner. And in addition, partner A would have $2,000 of ordinary income. Question 2. Consider the following example adopted from the legislative history. A commercial office building constructed by a partnership is projected to generate gross income of at least $100,000 per year indefinitely. Where do I get a piece of that action, right? Architect has a normal fee for architectural services is $40,000, contributes cash for 25% interest in the partnership, and receives both a 25% distributed share of net income for the life of the partnership and an allocation of $20,000 of partnership gross income for the first 2 years of the partnership operations after the property is leased. The partnership expects to have sufficient cash available to distribute $20,000 to architect in the first 2 years, and the agreement requires such a distribution. Is that a disguised payment? Louise, what do you say? Benny, what do you say? Louise? Disguise? Halloween or not? Anyone, by the way, next time I see you will be November. So, anyone have any Halloween costumes they've gotten? Batman? All right, I see a Batman. Any Wonder Woman out there? Come here, you're going to be a Wonder Woman?
Yes.
Okay, no doubt. Anyone, any other creative costumes out there?
Or maybe a costume.
Your daughter made your costume.
I'm going to be cotton candy.
You're going to be cotton candy. What does a cotton candy costume look
I have
like?
to show it to you.
All right, if you can, I'll circulate it to, if you don't mind, send it to me and I'll circulate it to the class. All right, I'm curious.
Forever volunteer information.
Okay, that gave you some time, Louise, to consider. Is this disguised payment? What do you think? Yes or no?
Some.
Was
Some
that?
of them.
I'm sorry?
Some of them.
So,
The service, architect service, the 40,000.
well, so are these payments disguised payments, Penny? Would you agree?
Disguise in what sense? Because does it, why is it?
Does 707A2A apply?
Yeah, I know. Again, why is he receiving the 20,000 payment? Is it in his,
So you're in trouble by the fact that getting these preferred payments very soon after the services are rendered, right?
Okay.
And doesn't look like much risk in getting those payments, right?
Yeah.
So it looks like the architect is being paid like an independent contractor, right? And that this probably, again, we got to use the word probably the IRS could invoke 707A2A and say this is a 707A1 payment, right? That this is as if it's being paid to a non-partner. There doesn't seem to be much risk. The payment seems contemporaneous in time. I mean, there's some other factors. He's staying on as a partner. But this payment really has an aroma as if it's being paid to a non-partner. Everyone agree?
So, like, what actually happens in year one? The architect gets, so that $20,000.
It's not a distributive share.
Okay.
So it's going to be
Partnership isn't
considered
deducted.
$20,000 payment. And we have to see if we have to capitalize it, right?
Okay.
Angie, we'd have to see if we've got to capitalize this payment, right? But if it's disguised as a distributive share, it may de facto
because
function as a
theoretically-
deduction.
I got it, okay.
Because everyone else gets less income, where if it's capitalized as a 707A1 payment, there's going to be more income.
Okay.
Okay? So again, for your notes, guys, if this is a disguise, Louise, in your notes it should say the answer that the IRS would invoke Code Section 707A2A, and that would be a bridge to get to Code Section 707A1. Aaron?
The architect has to take the whole 40,000 then in year one?
No, he's cash method taxpayer.
Oh, okay, so,
Right.
20 of it are ordinary income.
Right?
Right, because if the partnership was at a net loss for the year, and it wasn't, if you left it as a distributor share, then that never, and that's why the IRS.
Yeah, I mean,
Okay.
we need to know more, but it could be a way to camouflage a payment that should otherwise be capitalized.
Okay.
Right? Remember, anytime you have a distributed share and a special allocation, one person gets taxed, the other people have a reduced tax burden. All right. Next, we're going to talk about guaranteed payments. Okay? Again, remember, the first several weeks that we spent, we talked about distributed share of partnership income, right? You're a partner, you get a distributed share, depending on the percentage you own. And tonight, we're talking about a 707A1 payment as if you were a non-partner. But suppose you're acting in your capacity as a partner. Lafayette, Alicia, and I are partners. But you know what? I'm going to do a lot more work than these guys, okay? And as a result, I want X dollars, whatever X dollars, right? I want a guarantee. Guys, you gonna give me a guarantee? Okay, I like the way you think. And if I get a guarantee, that's called a guaranteed payment, okay? And that's the introduction of another form of payment, Code Section 707C. Now, a lot of tax is this way, so this is not the only place I will make this statement. You probably, but there's a famous Greek philosopher, and in this case, you guys will either know it or Luke can do a Google search on it, or Amber can, or someone can help me out. Yeah. There's the Greek philosopher who says you never put your foot in the same river twice, right? Who said that? Who is the? Is it Heraclitus? I'm trying to think of my Greek philosophers. Luke.
Heraclitus.
Is it Heraclitus? Look at me. I didn't even look that up. I'm telling you, you may think, okay, you looked it up before class, but I didn't. I swear to you, I didn't. So take that Greek philosophy home, right? You can never put your foot in the same river twice, right? That river always changes. Your foot's somewhat different too, so always in flux, right? And Dylan was wondering, where the hell is this going? All right, fair statement.
what the Greek dude was saying, but okay, that works too.
All right, but my point is, this world, and tax in particular, right, it's always changing, but guaranteed payments is truly changing. There's a movement afoot to change how guaranteed payments are taxed. For exam purposes, we're going to take the world as it is today, but I want you to know that if you had a chance to read some of the proposals that follow, it's understandable how the Treasury Department is moving with broader latitude to see a larger portion of the world as a guaranteed payment. So let's talk about that in a moment. But I just wanted to point out, again, this is changing. Guaranteed payments are changing. For our exam purposes, it won't be. But again, 10th edition, just like carried interest, the world is changing. This too, I suspect, is going to be different. So it's good to make sure that if and when these issues come up in your tax practice, guys, it's great that you remember some things, but always check and don't rest on, gee, this is what you remember what it was. It must still be the same. That's dangerous, right? All right. So the authors go through a short description of what is a guaranteed payment, and if you look at Code Section 707C this time, talks about the fact that guaranteed payments are determined without regard to the partnership income. Okay. And the authors remind us to treat as distributive shares that the timing, for timing purposes, Alicia, this is going to be at the same timing as distributive shares would be treated. And if you look on page 223, talks about the fact that if you do have a guaranteed payment, what happens to your outside basis in a partnership? Goes up, right? So if you have a guaranteed payment, even if you don't physically get the money, right? Even if you don't physically get the money, your basis in the partnership, outside basis, will go up. Gaines v. Commissioner talks about the taxpayer here is complaining about the asymmetry. But here the court rules, not surprisingly, in favor of the IRS and says that the fact the partnership could not deduct a payment, Angie, you'll appreciate it, the payment had to be capitalized under 263, so the payment couldn't be deducted, didn't mean that it wasn't a guaranteed payment to the partner. Okay, so if you look on page 225, I have highlighted in red the first few lines, after the first few lines of the indented language on page 225. Says this case does in fact involve quote-unquote guaranteed payments to a partner within the meaning of 707C. And the next line highlighted in red. The fact that no actual payments were made does not affect the status of these transactions as 707C guaranteed payments. case goes through, and again, I point out at the very end to myself, on page 227, the very last few lines, it says essentially, I have paraphrased in my notes, the fact that it's income to a partner, in this case guaranteed payment, does not necessarily mean it's deductible by the partnership. Okay? Again, here, not alone, asymmetrical outcomes are normative. Okay? Asymmetrical outcomes are not the exception to the rule, guys. If you read Revenue Ruling 69-180, it's very similar to the examples. If you get a chance, by the way, the examples under the regulations of guaranteed payments. Amara, you sound like you're an example reader under the regulations.
Yes.
Amara, if you read the examples, did you? I'm gonna.
No.
All right, but I know you will.
Yes.
Okay, and when you do, with respect to guaranteed payments, they're fairly easy to follow. And again, let me emphasize, I can't, for exam purposes, really go outside that, okay? So if you have a chance, take 15 minutes. You guys feel yourself fortunate that the regulations and the examples, as you know, there's substantial economic effect. Very lengthy, and the examples can go on a few pages. The examples here are very succinct, right? That's the right SAT word, succinct and terse and to the point. So if you get a chance, spend 15 minutes looking at the examples here. You'll see this revenue ruling follows essentially right from the examples in the regulations. And make sure on page 228 you can follow this little chart here. We're going to go through some examples that mimic this, but make sure that you can see where the authors of this revenue ruling came up with these numbers. I point out that in the note that follows, just like Heraclitus talked about that river, on page 229, you can see that there's new proposed regulations that are going to read guaranteed payments far more expansively. So be forewarned that in time to come, the world's going to change with respect to guaranteed payments. In Revenue Ruling 2007-40, this revenue ruling and its outcome will not come as a surprise, I think, to anyone in this room. Suppose you use appreciated property. Suppose you use appreciated property to fulfill your obligation with respect to a guaranteed payment. Suppose you use appreciated property. A partnership owes a guaranteed payment, and it uses appreciated property to satisfy that guaranteed payment. Sound familiar? Sound like a case everyone here has studied? The use of appreciated property to satisfy a debt. The famous what case? I know you're all thinking the Keenan case, right? K-E-N-A-N, the famous Keenan case. And if you look on page 230, the last full paragraph, what does it say? A transfer of partnership property in satisfaction of a partnership's obligation to make a guaranteed payment under Section 707C as a sale or exchange under Code Section 1001. Sound familiar? Again, Keenan case, right, guys? So if the partnership uses appreciated property to fulfill its obligations, it's going to be treated as a guaranteed payment. I mean, as a recognition of it. Why don't we do the first problem on page 231, and then we'll take a break. How's that sound? Do one problem, and then that will get us ready for the remaining problems. All right, everybody have page 231? The AB equal partnership is a highly speculative business in which profits fluctuate widely. The current year, the partnership has profits of $20,000, of which $12,000 is ordinary and $8,000 is long-term capital gain. A and B share profits and losses equally unless otherwise provided. A renders services to the partnership which are continuous, related to the function of the partnership, and not in the nature, right? And you have a capital expenditure, right? And this is pointing out, this is not in code section 707A1, right? This is not, right? It makes it a point that it's within the function of the partnership. Everyone agree? That's why the author spelled toner here, just to make sure everyone knew that code section 707A1 did not apply here. Okay? What results that A, B, and the partnership, A worked for the partnership and was required to be paid $15,000 per year for his services, regardless of the income of the partnership. So A says, hey, I'm doing a lot of work. I want $15,000. So I'll just call to your attention. Mar, you'll appreciate this. This is straight from Regulation 707-1C, Example 1. I'll repeat. 707-1C, Example 1. All right, so I need to do a little role play here. So, Yolanda, you want to be A, Jesse, you want to be B, and Annetta, you want to be the partnership. Okay, everyone have their role? Yolanda's A, Jesse's B, Annetta is the partnership. Partnership, what happens here?
I would say it's deductible, the 15,000, right? It's just
How much for your deduction?
15 per year.
15,000, okay. Tell me more, how much income does that leave for your partners?
5, right? Just since we make 20 a year, so 5 left. That was split it equally.
So, just tell me the character of the income.
Okay, so out of the 15, 12 ordinary income, long-term capital gain.
Well, we start off, right, Yolanda, with ordinary income of 12, right? Capital gain of how much?
8.
8, right? So, Yolanda, what do you want to say regarding the partnership?
To split equally.
But I mean, there's guaranteed payment of 15, so what are you going to do about that?
It's for A. In A income,
Well, A is going to take the 15 into income. Everyone agree? What kind of income? Ordinary income, right? And the timing, whenever the partnership year closes, because it's guaranteed payment, that's when he has to take it. No matter what, whether or not he gets physically the money, even if he's a cash method, it doesn't matter, right? Got to take it into income. Agreed? Okay? So what effect does that have on the partnership, the guaranteed payment? Amber? Or Amber, go ahead, and then Anthony, see if you agree.
So the 12,000 ordinary income, you need to take away the 15 of the guaranteed payment, so it's a loss of 3,000 to the partnership.
Anthony, agree?
Ordinary loss.
All right. I mean, the guaranteed payment, right, is going to make this 3,000 ordinary loss. Jesse, where does that leave you as the partner B? Where does that leave you, Jesse?
I'm not really sure.
Just say it loudly.
I'm not sure about that.
So you split?
Yeah, I'm not trying to make this harder than it looks. You have 1,500.